Now, I haven't said our favorite term, which is please like, share, and subscribe. Your support is appreciated. And one of the things that we wanted to talk about, because I found this on a website, just looking at who is investing, and who is taking out debt to invest. Now, the sample set is small. I'm not saying that it is a full sample set at all, but when you look at the percent of equities by household, when you look at the percentage of people, retail investors, how aggressive they've become, how large they've become in the industry, a lot of this starts to make a bit more sense. So when you look at have you taken on debt to invest, 40% have said yes. And when you look at who has done that, well, if you look at Gen Z and millennials, 80% have said yes for the Gen Z and 60% of millennials have said yes. So people are borrowing in order to essentially trade stocks. And when you think about trading stocks, a lot of them are already trading on leverage. So it's just showing the compounding problem that continues to evolve within the underlying economy, the underlying market, which is why we've seen this big divergence of economic growth and stock market growth. Now, when you look at the type of debt consumers took to invest, many of them have taken either a personal loan or borrowed from friends and family or went into credit card debt, obviously is the biggest component. And this is, again, when you look at how people view credit, how cheap it is, how available it is, well, why not just get something for 3%? Because, you look at Bitcoin and you can make 100%. So I'm borrowing for 3% to make 100%. And if you were to watch TikTok or all these other things, you would assume that there's no risk. So why not? Everybody wins. So these are things that become these excess caveats that we like to look at and talk about when we see what has been coming down the pike and is a bit frightening. And just to put that into context, when we look at just the household equity allocation, this is what we were talking about with the percent of total financial assets. So when you look at the total financial assets per household, there we have one of the largest essentially percentages of equities ever, going back to the 1940s. So when you look at just the elevated level and the amount of equities that are being held, to think that people are going into debt to do it doesn't seem like a huge stretch, especially when you look at these peaks, which have unfortunately come at very precarious times in our economy's history. So now when you look at what the U.S. consumer, well, they utilize Google a lot. So when you utilize Google, you can get an idea of where some of those interests lie, and you can look at day trading remains up there as you, again, coming back to taking out some of those loans, trying to get some of this activity. But commodities and cryptocurrency have started to fall off a bit. And when you look at how aggressive they went in terms of cryptomania, and then in terms of where we sit today, you're starting to see some of these adjustments in terms of how individuals are looking. And it's always interesting because it seems as though Google Trends are a pretty good leading indicator for where some of these prices will go and this exuberance that then goes away. So this is just something that we like to talk about and look at. Now, as we go into Q2, there's two different ways to look at where some of these expectations are. The Atlanta Fed has their GDP now, which is printing close to about 10.2%. When you look at just where the Atlanta Fed is saying the Q2 GDP will come in. But then the question is always, okay, well, what is the GDP deflator or that price metric that we can take out to really get real GDP growth? And really, is it sustainable? Because we had a lot of transfers, we had a lot of stimulus come through, so you could easily get this big pop and then the fade, which we started to see in the PMIs as we go into the end of June. So then when we look at it a little bit differently, because the New York Fed also has something that's similar, but you can see that on their economic index, they're still close to a little over 10%. So there's this continuous view that we're going to have something very close to over a 10% increase in GDP. But yet when you look at the bond side, so bonds price in a lot of things, and one of them is underlying economic activity. So even given I'm not someone who is very bullish the U.S. economy, but I'm also not bearish the U.S. economy. It's just there's a lot of caveats within where we sit. We had a lot of manufacturing growth, which is now paring back, which is leading into more service growth. But all of this is still showing a lot of growth. But how much of it is driven by the government? How much of it is driven by stimulus? I mean, we had about $13 trillion worth of stimulus, with another, ending the year at about 15. That's a lot of transfers. That's a lot of money coming into the market that is, again, providing this early bump. And as we said in segment 1, you get this big bump because of stimulus, and then you get not a fully offsetting, but a drag on the economy after that, because the consumer was hot, things were running hot, inflation goes hot, and then things start to impact. And that's where you start to see some of this economic slowdown. There's base effect month over month, not saying there isn't, but there's also some of these impacts that becomes a drag on the back end. So now when we look at PMIs in general, here you can see just where things sit, and it's important to understand where this is in relation to underlying expectations, which I forgot to pull up, so I will pull it up right now just so we can compare apples to apples. So when we look at manufacturing PMI at 62.6, it was expected to be at 61.5. So we continue to have some of this strength in the manufacturing side. Now, the services sector was supposed to be at 70. Instead, it came in at 64.8, bringing the U.S. composite to 63.9. So on the service side and the composite side, we actually had a pretty big slowdown on a month-over-month level, which, if you think about the consumer and how the consumer is adjusted after, May was a very strong month. That there was the stimulus, there was tax refunds, there was a lot of things coming to the consumer that allowed for some of this bump up, which then went away. Again, still all growth. They're all over 50. There's still expansion. But it's getting closer to the peak, and manufacturing is another one starting to roll over a bit. Again, all of them are good numbers. It's just they're extended at this point now, and this is where we've been talking about, as we said last month and the month before, we're coming into a peak, and we're going to start to see some of this slowdown. So price pressures also remained elevated in June. The rate of input price inflation softened slightly, but was the second fastest on record. So we're still seeing those price input increases. It's not the same. And this is where, when we start talking about these leading indicators for stagnation, stagflation, this is one of those big ones that you have to take a pause and say, okay, guys, what does this mean going forward, and how is this going to impact the consumer pricing? Manufacturers continue to note rapid increases in raw material and fuel costs, while service providers highlighted higher wage bills to attract workers, plus greater transportation fees and fuel costs. Again, underlying bids that we continue to see that is driving up costs. Higher costs were commonly passed on to clients through a steep rise in output charges during June. So even though we saw some cool off in price and input price, we still had another big increase in the underlying prices paid. So the increase in selling prices was the second sharpest since data collection began in October 2019. Employment issues remained prevalent during June, as numerous panelists mentioned difficulties finding suitably trained candidates for current vacancies. As I said in the summary part of part 1, I just want to reiterate the wording there. Suitably trained candidates for current vacancies. Companies are being very picky on who they're hiring, and that continues to be the underlying issue. I think that's the most prevalent right now in terms of, there's a lot of people unemployed. I'm going to find someone who I want, someone who has the right skill set, and this is where we continue to see some of these issues. Although the rate of creation remained strong overall, growth in backlogs of work was also among the highest seen over the past decade. Backlogs because of supply chain issues. Amid worsening vendor performance, input prices soared once again at the end of the second quarter. The rate of input cost inflation accelerated to a fresh series record high amid broad-based raw material and price hikes. Firms raised their selling prices at a quicker rate in an effort to pass on these prices in general. This is talking manufacturing. Unlike their service sector counterparts, goods producers expressed a greater degree of confidence in future output during June. Firms reportedly hope that an end to restrictions and further increases in customer demand will boost output over the next year. So some of these things are continuing to be big drivers overall. And that's why when we look at some of the underlying PMI inputs, there's some that are, even though they're technically positive in terms of pushing it into expansion, there's some negative expansion because it has a negative implication to the company as well as to the consumer when you look at underlying inflation and just and overall pricing metrics in general. So this is just from Chris Williamson, the chief business economist at IHS Market. I just wanted to throw up some of these quotes because I think they're very good at highlighting some of the underlying components that we continue to see. And I just want to call one out just because you can read this at your leisure. But although price gauges have also slipped from May's all-time highs, it's clear that the economy continues to run very hot. Prices charged for goods and services are still rising very sharply. Record supply shortages are getting worse rather than better. Firms are fighting to fill vacancies and manufacturers' warehouse stocks are being depleted at a worrying rate as firms struggle to meet demand. That, in a nutshell, is where inflation stays and gives way to stagflation. So now when we look at Philly Fed versus the ISM manufacturing, you can kind of see where that correlation is and what we're seeing for the underlying Philly Fed and ISM backdrop. But when we pull out a bit and look at, okay, well, let's talk about import prices. Let's talk about what this means. So as we've been talking about import prices, the importing of inflation continues to be a big driver as all imports, excluding petroleum, continue to drive higher. And based on everything we've seen from international PPI, shipping rates, massive delays that continue to reach all-time highs, this is not going away. It may stop rising, but it's not going to reverse anytime soon. Now, some of the benefits of having a stronger dollar is going to be that your dollar goes further. So there's also going to be some of that where some of this will kind of flatline, if you will, only because you're going to have some of this trade-weighted dollars getting better, providing a bit more buying power, which again will also be a little bit of a headwind to some of those future increases. But now when we turn to some of the internals of the Philly Fed, you can see prices paid, again, all-time high. Prices received, all-time high. I should say, based on what we're seeing back to 2005. So you're seeing that the prices paid, which is at 80, prices received at 50. So there's still more to get passed on. And even if you start to see a pause, because on our way higher, there's been 2 pauses on prices paid. There's been very little pause on prices received because we continue to try to push down and bring some of that all the way through. So now when we look at Philadelphia manufacturing, so the manufacturing started to slow a bit and new orders started to slow, but there is an increase in backlog. So again, there's a certain amount of catch up, and this isn't continuous because the Richmond Fed had something a little bit different with manufacturing at highs, some of the new orders also going at highs. So it's also showing that there's a little bit of a bifurcation within the U.S. on who is seeing some of this growth, but we are seeing some of this moderate as we had been talking about previously. So then when we look at delivery times have gotten a bit better, but it's also because we've shortened, there's been a shutdown, as we said last month. There was a slowdown in activity, which allowed some of the deliveries to catch up, but even though we've seen some catch up, you can see the work week for the Philly employee is actually getting, Philly Fed manufacturing is actually getting worse because we still have some shutdowns, we still have some furloughs as they're waiting for some of this to recoup. So then if we switch to the Richmond Fed manufacturing, prices paid, prices received, you can see that there's a little bit of again, this topping. And that's where we talk about some of the different implications, because some of the prices are going up, some of the prices are starting to moderate a bit. And this is where it's more about a pause and a sideways versus a stop and then a fall. This is where we, again, coming back to the conversation around where are we going to see inflation versus stagnation. So then when we looked and we turned to the Richmond Fed in general, here you can see the composite, turned up, but employment got a little bit worse. So manufacturing Richmond Fed stronger than expected in June at 22 versus 18 prior month. New orders, business conditions stronger. Lead times down slightly, but still very stretched. Employment CapEx ticked down, but still expansionary. 6-month outlook still quite healthy. So this is where employment has slowed, and that's what we keep talking about, where you had this big surge, and now people are like, well, how much does it cost for that new employee? How much do I have to train that new employee? Well, some of my hourly workers are coming down. I can use them more, and this is where you keep seeing this fluctuation of employment, and it starts to explain some of those disconnects between job availability, and some of that stickiness in the unemployment side. And then now just to introduce this, we'll talk more about this in the next segment, but existing home sale prices continue to explode higher. Medium sale prices continue to explode higher. And this is something that is going to be some of that stickiness when we think about some of that inflationary pressure, because CPI has not calculated or has not caught up with where a lot of these prices reside and where these prices have gone. So then when we turn to the Richmond Fed manufacturing side, just to finish this out, look at the inventory levels of finished products. The lowest it's been since going back to 2005, because inventory levels make companies, price takers, don't have the ability to diversify. This is going to be that big overhang that we continue to see. Even as things start to slow down in terms of demand and consumer consumption, you're still going to have them looking to at least get close to normal on a inventory side. So then when you look at the Q1 current account deficit widened to almost $200 billion at 195.5 versus an estimate of 206 and 175.1 billion in the prior month, revised from 188 billion, now at the widest since 2007. So it was better than expectations, but still really bad. And this is something where when you look at the import side, it was poor more because there's delays and it comes down to when is it calculated. Like, were some of the shipments that were being calculated to come up with the estimate not in Q1, instead fell into Q2? This just shows that, at least in my opinion, that we're going to continue to see this expand as imports run hot. We continue to import to try to make up for some of these shortfalls, and we're going to see some of the stickiness in terms of price increases. Now, while we have prices going up, we have wages that have been lackluster. Employee compensation as a share of national income. Wages and benefits averaged 72% of national income from 1970 to 1995, then steadily declined to 65% by 2014. Increasing share of pie went to business owners and white-collar workers as tech adoption picked up and union membership declined. So this is where, when we look at employee compensation, has been moving on the wrong angle. So even though we've gotten some wage expansion, we still are sitting under a significant amount of wage compression that has yet to come up, yet to normalize. And now with so much cost being rolled in based on supply, raw materials, companies are unwilling to try to increase some of these labor costs because it's going to get difficult, and we're starting to see the consumer reject pricing, again, coming to the stagflation side, which is going to limit the amount that they can continue to pass on this pricing. So then when we look at change in average weekly earnings since Feb 2020, we have seen an increase, but the increase has been in leisure. And when you look at, a lot of these are coming from a very low base, like people in leisure and hospitality and retail, where they're getting paid $12 an hour. So an increase of 5-10% on $12 an hour is very different than a 10% increase on someone making $150,000 a year. These are the types of differences. So that's where we continue to see some of these shortfalls, and there's more and more investment in automation, in redundancies. So it's going to be hard to see some of this growth, even though prices have gone up. The average hour worked has gone up. The total number of people working still remains below where we were in February of 2020, which is why and it keeps proving out here, as we said back in March of 2020, April of 2020, you were going to get the huge move down, you were going to get that check mark back up, and then you were going to go flat. And it was going to be a very slow grind back. And instead of being this big check mark back to the top, it's going to take more time, and we continue to see this struggle as we try to get back to some sort of normalcy. So then when we talked about the people who have retired, the pandemic accelerated early retirement. So when you look at the U.S. population who is retired and a percentage of population who is retired, you can see just how it has grown. It exploded through 20, and now it continues to increase through 2021. So this comes to, well, how many people are actually participating? Are people who have taken retirement packages or severance packages that plan to retire, or took the severance and are taking unemployment, and then the moment unemployment is expired, they just are going to go away because they're like, hey, I can catch some extra money and then move on. Like, this is where we start to see some of that skew in some of the different data sets, which is why when we look at the U.S. percentage point change in participation rates, here you can see we still are remaining below normal on the participation rate. So there's people that might still have severances. They might still be collecting their unemployment. And this is where we're seeing some of this conflict in terms of, well, what is participation rate? Is this the right way to look at it, or is this under? And we actually have a higher participation rate because things aren't being calculated the same, because some of these individuals who are retired or going to retire are being factored in, and we need to adjust some of these data sets. And when you look at just the growth rate of babies, because it comes down to, well, how many people are going to be needed to support those who have retired in pensions and 401ks? And here's where you can look at just the drop in the growth rate. And typically you need about 2.1 to maintain flat growth. Now, the U.S. has has maintained a fairly large influx of immigrants, which has kept us in our populace growing, but it's not coming from a natural growth of babies in terms of fertility, because fertility continues to drop below, as you can see, sitting in at about 1.7, which is obviously at a shrinking profile. Now, some of these others have started to flatline, but this is going to become a bigger and bigger problem when we look at people in the workforce, productivity in the workforce, and what does that mean on a go-forward level. Then when we look at jobs and just the search activity, the areas that have seen their, ending June 12th, this is looking at where those the state unemployment benefits are cut off because they expire. We didn't see an increase in any of this searching for jobs. And that's why, was it really this excess capacity that was keeping people on the sidelines, or is it something else? And that's where we continue to see some of these impacts as to what is opting out, who is opting out. And you can see that things that are ending June 26th and 30th, June 3rd and 10th, those remain elevated. So maybe you saw this big increase. People searched. They're now in the process of interviewing, so they don't need to continue to apply. There's a lot of ways to kind of spin this data, but it's an interesting data set to see that maybe there's something else behind some of the slowdown in people coming back to work, because job postings are now at 30.5% above February 1st of 2020. So you're seeing a lot of new jobs, but how many of these are actual jobs? How many people can actually work? How many of them are just kind of testing the waters? These are the different kind of push points that we continue to see that make the number a little bit harder to appreciate or understand. Also, you have companies' automation priorities now extend beyond saving money. So it was before a matter of saving money. Now it's improved business continuity, business resilience, improved customer experience. It's no longer the lower cost side, lower risk, increased ease of generating business insights, improved business continuity, ways to automate, ways to create more work from home, flexible schedules, which is another reason why I think this is going to become a bit more sticky than I think the market is anticipating. Then when you look at companies planning to adopt a broader range of technologies to achieve more value from automation, workflow automation, process understanding, but the workflow automation is going to cut into wages, benefits. How many people do I have to hire? If I can automate 60% of the workflow, do I need 2 employees or 1? And these are things that we continue to see in terms of the plans to use, and this is going to become an overarching problem on getting people back to work. And then the young workers burden. This comes back to, in a different way, not just the baby side and the fertility side, but it's already an issue now. We're already seeing the problem because the number of Americans available to support the elderly is getting smaller. And based on the fertility rates, it's not getting any better. It's only getting worse. And that's where we continue to see this prolonged issue that's rolling through, measured in decades, as you can see, as we go well into 2050. And the big drop off, if you layer on where fertility rates are, this is where we continue to see these pressures, and this is going to become a bigger overarching problem when we look at economic growth, manufacturing, economic expansion. These are some of those issues that are going to become, I think, a bigger and bigger focal point as we go through the remainder of this decade and into next, to find ways, which is why investment in automation, trying to do things to make, to replace individuals, because there's not going to be as many individuals to support what is already out there. So it's going to have to come from cost and other types of efficiencies. Now, in the next segment, we're going to go a bit more into housing, inflation, and home prices, which we started to talk about in this previous segment.